Welcome back, and welcome back to Knowing Your Taxes. A number of questions have come through the chat while we were at break. So before I start with the presentation, let me make an attempt to answer some of those questions. The question is, how would you know what amount is due when you file the income tax? The income tax form is so designed that the relevant income that you have earned will be placed on it in a particular location, and from that location forward, there are the relevant deductions and allowances and claims that you can make sequentially. And at the end of the documentation for the tax form on page 2, in this case, of the individual emolument form, they will tell you what your chargeable income is. So in other words, you take your income and minus all your allowances. So your income is not your taxable income yet. The income, after you take off all your charges and allowances, you now come to your taxable income. And it's that taxable income that your calculations will be made with regard to the amount of tax exposure you have. The form, and I'll be showing in a little while, will indicate to you exactly what the calculation is. 25% of whatever your chargeable income is, and we work it out based on the amount of money you earn. You can go up to 30% based on the amount of money you earn. So from completion of the tax return form, the answer to what your tax liability is will emerge based on the calculations that you make while you go through the form and filling out of the form. The question here, so business levy has not to do with that. Business levy is based on the income. Business levy or green fund levy, depending on what you're paying, is based on the income that you make in the quarter in question. So for January, February, and March, you should have paid based on the income for January, February, and March on the 31st of March. Income for April, May, and June should be paid on the 30th of June. So it's a calculation that you're making. If you are required to pay business levy or green fund levy or these quarterly payments, it is based on the income that you have made for those 3 months. With regard to income tax or corporation tax quarterly payments, if you do not know your income, let's say for those 3 months properly, you can do it based on an estimate, and you look back for the similar period last year as to what you earned last year, and then calculate it based on that figure and provide some payment based on that figure or an estimate of what you think it would be. The question here is a long one, so let's go through it slowly. If you are registered as a limited liability, therefore you and others are listed as the directors. That is true. Being small, the directors also run the business. That is true. Should the directors be employees in the business and therefore have emolument income? And the answer to that is yes, because there's no other way that you can take out the money legitimately out of the business. So if you're working in the business as a director, you should be on the payroll. That's the best way to do it. A client of mine is, let's say, a dentist or a hairdresser. Not a hairdresser, but she's a hairdresser with a limited liability company. All right, that's true. She's a hairdresser with a limited liability company. And let's say you're a dentist with a limited liability company. You got to put yourself on the payroll in order to get money out of the business. And that way you have to pay PAYE and national insurance. There are some persons who, for one of a view that national insurance is beneficial and you want to get national insurance claims and stuff, if you're a limited liability company, you put yourself on the payroll and do it that way too. Or would they file individual tax returns? They have to file individual tax returns. And the company, if you're a limited liability, the company has a limited liability, it must file its own tax returns. It will have its own number. If you're a sole trader, that's a different matter. Your number, your personal number, and that of the sole trader business is one and the same. All right, so in the case of a corporation, therefore, in the case of if you have a limited liability company, the directors should be made employees if they are working in the company, and health surcharge, national insurance, tax deductions will be made under the PAYE system, in this case for taxes. National insurance and the health surcharge will be paid by them through the company. The individuals don't have the responsibility, but the company has the responsibility to ensure that the right taxes and payments are made to the relevant statutory bodies. All right, so the limited liability, please do it that way. All right, let's get into this thing of expenses. Now, this is nice because we begin to know what we can use for tax purposes, what we call allowable business expenses. I'm allowed to use this expense as a business expense. And boy, will I be happy if I could use everything, but I can't. All right. As a general rule, therefore, expenses will be allowed if it is incurred wholly and exclusively for the production of income. Expenses will be allowed if it is wholly and exclusively used for the production of income. Domestic or private expenses will be disallowed. Domestic or private expenses for your home or yourself will not be allowed for business purposes, with a caveat. There's a caveat to that, and we'll talk about in a minute. Therefore, it is incumbent upon you to provide the expenses that you want to claim for and show that it's supported by the income that you're generating. For example, in the case of entertainment, all restaurant receipts should be kept, and at the back of the receipt, you need to should indicate what or who you had the dinner with, and maybe a little in the description of what the purpose was. So there's some what we call business allowable expenses, and there are expenses for private purposes that will not be allowed for business purpose. But let's discuss them in more detail because it's important that you understand this and why it is that you should have good records to prove. Allowable expenses will be any accounting charges that you have. You're paying your accountant to do your work, sure, that's allowable expense. Your advertising, promotion, it's a business expense. Other trade expenses is a business expense. Bad debts is a business expense, and bad debts is where you're writing off a debt for somebody who didn't pay you. You had counted it as sales some months before, and it was a receivable that they didn't pay, and you want to write it off. It's a bad debt. Therefore, you want to recover that money from your sale, from avoid paying any more additional taxes. It's a bad debt. It's an expense that is allowable. Your utility bills, electricity, water, entertainment, only 75% of the cost of your entertainment. So it's not, you can't be freewheeling on the entertainment because only 75% of that entertainment bill is allowable for tax purposes. Only 75%. So you are sole traders, and I want to make it very clear. You are sole traders. You go out to dinner to do some business, it's a business expense. But only 75% you can claim in your tax return for business purposes. You have an insurance premium. That insurance premium has to relate to the business. It's not your personal life insurance. As a sole trader, your personal life insurance has nothing to do with the business. All right? Now, in some cases, some persons insure their life for which the business will benefit. It's called key man insurance in some places. That is where the insurance is taken out and the business pays it, because if anything happens to you, the business will get the compensation or the business will get some cash benefit from that purposes. For all intents and purposes, at the end of this presentation, somewhere between Monday or Tuesday, you will have all the slides and all the handouts with regard to the document conversations that we're having, so that you can follow and review and revise as you so choose. Interest on banks and bank charges is also a legitimate business expense. Your licenses, your motor vehicle operating expenses, your traveling expenses, your rents, your stationery, your office supplies, your wages and salaries, wear and tear. I want you to look at this and understand why we must have records for your business. So that you have your records of income, and you know what that is, but you should also put your books and records in order, so you have your categorizing your expenses in this manner so that you know how to come to a point where you have your net income. Let's see, so that some of you are sole traders, and keeping these records is important for the calculation of your taxes. What about owner-occupied property? What about owner-occupied property? Where an owner carries on a business and also lives in the same premises. You're entitled to claim expenses for the following items in a proportion in which he or she operates the business. So I am operating in my house as we speak. I live upstairs and my business is downstairs. I pay a mortgage of $3,000. So the whole house upstairs is the business, and the whole house downstairs is the business, and the whole house upstairs is the house. Then 50% of the mortgage payment, assuming that the house is half and half, half business upstairs, half business downstairs, you will pay 50% of your mortgage payment is a tax relief. You have your house rates, your water rates and sewage rates, your land taxes, or what we call property taxes, land rent, fire insurance for the house, repairs to the section of the business that is used for the business is deductible, interest on the mortgage. So for many of you, therefore, who are living and working in your property and running the business, start getting the documents or the bills and copies of the bills for the household so that you can put it into your business expense. It's a legitimate business expense. And just for everyone, slides of this week and last week. Last week's slides went out late, my bad, but you'll have all of that coming to you very shortly. These expenses apply to sole traders. The answer is yes. And that's why it's important for you all as sole traders. If you have an expense that you can legitimately write off, then go get the expense and write it off as a legitimate business expense, because that way you have less taxes to pay. I live with my mother, I live by myself, or I rent a government HEC house, then I have my water rate bill, I pay it, but I know 2/3 of that belong to the business. I pay the water rates, I pay the land taxes when they come to property tax, fire insurance for the building, we pay a section used for the business, interest on the mortgage. All of those things make up business legitimate expense, or a proportion of it can be applied to your business. We have something called wear and tear. This is an allowance that allows entities to treat a portion of the cost for fixed assets as an expense. I repeat what that is. This is where you have a portion of the expense for fixed assets. So I am in business. I buy a computer. I spend $7,000 or $8,000, $9,000 on buying a computer. It's a fixed asset. Computer. I don't expense the entire computer in 1 year. I have to therefore treat it as an asset and write off a piece of it over its useful life. For tax purposes, I can write off 33 1/3% of the computer purchase price over the life of the computer. I repeat that. You buy a computer, you have a computer. If you have a computer now and you're a business person, then bring the computer into the business, because you're using it for the business and using it for other things too, but bring it into the business because 33 1/3% of that cost could be written off on an annual basis. The 7th schedule of the Act, the Insurance Act, that the Income Tax Act, will tell you what the wear and tear rates are. But for computers, it's 33 1/3%. For some assets, it's 25%. For building, it's 3%. There's no charge for land. There's no land write-off. But for building, you can write off probably about 3%. And for other assets, somewhere between 20 and 25%, depending on what the asset is. Where some assets are used to manufacture a product, where you're manufacturing a product, therefore you have an initial allowance where you can write off 90% of the cost of the asset in the first year. So here's where it gets complicated, because accountants have a way of working depreciation, and the tax man says to you something called wear and tear. Wear and tear is really depreciation. So you have to learn to appreciate how to treat with depreciation in your income statement And that's why understanding accounting and bookkeeping in terms of balance sheets as against income statement and where assets are as opposed to liabilities and where expenses are is something you need to become familiar with. Will be good. With regard to the issue, there's a question here with regard to, do you have a slide showing what portion of these expenses can be attributed to a business expense? No, I don't have a slide doing that. It's very straightforward to say to you. If I'm living in my mother's home or my father's home, you have to make an assessment. If my half of the house is used for the property for the business, then it's 50% of the expense for the mortgage interest. If it is for the lights, it's 50%. Now, if it is that I have a room in the house, so it is a 3-bedroom house, and I'm operating in a room in the house, then count the number of rooms in the house, and okay, 1 out of the 4 rooms in the house is where you have this business, then 1/4 of those expenses go to the business expense. You have to create the proportion. You can't overdo it. You can't, you just pick up any figure. No, it's a proportion of the expenses. If there's a room in a house and the house has 4 rooms, then 1/4 of it is an expense to the business. There are some items for personal use when you're coming to be a sole trader. We'll talk about that in a little while. So that's that one. Let's talk about trading losses. And I was talking to you about this just now, and it's very, very important. In any income year, if the sum of allowable expenses exceeds your receipts and your sales, such losses can be carried forward in subsequent income years to be written off. This is referred to as loss relief. And that's why being in business is such a nice thing when you understand it well and you know what to do. Because here it is. You asked the question a while ago. So I set up the business and I'm spending money on getting myself organized, but I didn't trade. So in 2019, I did all of that and I spent $50,000 in expenses for the business, not fixed asset purchases, but expenses for the business. Not fixed asset purchases, but expenses for the business. Then what you can do, a percentage of the fixed assets you purchase will be written off as wear and tear in the year as an expense, plus whatever expenses that you make in buying material when I'm doing certain things, telephone, lights, and water and stuff like that. Those expenses can be calculated with an expenditure statement, income 0, expenses X, and that X is the loss carried forward that you can be used to be written off over and against future profits. So if I have a loss in my first year of $100,000, and the next year I started operation and I only made $15,000 profit, then I pay no taxes because I have to write off now at $15,000 against the $100,000, and I'm left with $85,000 losses to go forward to the next year. And that will go forward until the $100,000 was written off before I pay a stitch of tax. So that's why if you understand that, people, when you set up the business, keep records so that you know exactly how you can find ways to reduce your tax liabilities. Let's talk a little bit about donations, because some of us have tithes, some of us have donations to church, some of us have donations to charitable organizations. Only donations that are tax deductible are those under a deed of covenant. Only donations that are tax deductible are made under a deed of covenant. So when you make a donation, we're not looking at that for tax purposes at all, unless you make it under a deed of covenant. A tax deduction is allowable for an individual or company who makes a payment to a charitable body who is a registered charity or an institution who is registered under a deed of covenant. This deduction is equal to 15% of your total income. So you could contribute up to 15% of your total income and get a tax write-off for it. How we do this? If you look at an organization such as Habitat for Humanity that builds houses for people, you can go to them and get a deed of covenant. There are some churches that you pay tithes, you can get the church to give you a deed of covenant statement at the end of a year because they are registered charity, and therefore they can give you this deed of covenant. You can get it registered, pay amount of money in your tithes through your deed of covenant, and relieve yourself of some tax exposure. Covenant donations mean payments that are made to a charity under a deed of covenant in favor. Sporting bodies may be so defined in terms of the section of the Act. Ecclesiastical, charitable organizations, educational institutions who have the charitable status, who have the issue deed of covenants, can be done. The Children Life Fund is also deed of covenant contribution statement issue, so that you can do those contributions through those entities and get tax relief against your income, up to 15% of your gross earnings. I do appreciate that what we have been doing is quite a lot. Take it very slowly. I've gone through a lot of it right now, and some of it you are grasping. I do appreciate it and I hope that you do. It might get a bit complex, not really, but we will talk it through very slowly and we will show you some things. I am using the baseline 2017, 2020, show you 2016, 2017 where the taxes are. But much of what you see here will exist within the context of your tax return form. The information is there on the form to guide you as to what you're dealing with. On the tax return form, you will know what your tax charges are. So you have what we call taxable allowances. These are things that you have. These are things that you have that you are allowed to take off for tax purposes based on the calculations. Remember, the question was asked before, how do I know what taxes to pay? And the completion of the tax return form, you come to a point of doing the calculation and you have all these little percentages that you have to work out by, create percentages of chargeable income, and you'll get a sense of what your taxes are. The chargeable income for under $1 million is 25%. So 25% of your net earnings, 25% of your net earnings is that would be charged for taxes. When you make above $1 million, and hopefully one day we all will do that, it will be 30%. If you are a sole trader or an individual, you have a personal allowance of $72,000. You have a personal allowance. So after you make your income, whatever that income is, before we start to calculate tax, we take off $72,000. Hey, that's yours tax-free. Tertiary education, $68,000. Pension annuity, deferred annuity, $50,000. National insurance is costing 70% of the national insurance contribution. First-time homeowners, $25,000 contributions to deed of covenant, up to 50% of total income. Venture capital, CNG, solar, and those things might not be you're affected by, but you need to understand. By the way, the rate for severance benefit here has gone up, and that's supposed to be $500,000. That was taken up in a quickly when we did the pension went down. They increased the limit on severance benefit. So there's a lot of rates you'll find on the current and relevant tax return form. I'm going to 2016, 2017 because I want to show you something, and then I'll bring you forward back into 2018 if you don't mind, and 2019. But here's a simple tax return form. And you're saying that the income from employment is actually $1.5 million from employment. You take off your personal allowance of 72. You deduct your first-time homeowners, 25,000. You deduct the tertiary education, $60,000. You have to have somebody in school, of course. You deduct your approved annuity up to a maximum of $50,000, which your national insurance included. And then, of course, you have a covenant, which is 15%, but you only paid 5%. If you paid, you can only claim what you have paid into the covenant. Once you took this, for the taxable allowances, what I'm allowed, I can take off what I'm allowed for my income before I arrive at what we call chargeable income. And once we get to the chargeable income, it is then we will calculate what the tax would be on that chargeable income. So for those of you who want to do simple arithmetic and simple summation, is simply this. Give me my income from employment, or give me my income from my business net, with whatever adjustments, and then I take out my personal allowances. Take out all what I consider to be tax allowable expenses, and therefore personal allowances, deduction for first-time homeowners, tertiary education, deduction for annuities and stuff like that will come in, and after that you calculate your tax based on your chargeable income. Income tax 25% for the first set of up to $1 million. It is 25%, and anything excess of that is 30%, and there will be your tax liability, $336,400. Simple as that. Simple as that. But I'm going to show you this in a different way later on, so that we need to be mindful of those things. These are taxable allowances for sole traders and individuals. But I just want to talk a little bit about corporation tax I'm doing 2017 again, but I'll come back and bring you up to date in a little while. But I want to draw your attention to the fact that the allowances as a sole trader, the allowances also as persons as in a corporation. And if you're limited liability, you have certain fashion allowances that you can take. You have certain audiovisual production activities that you can take, which will be relevant to you. When we say 150% uplift, what we mean is that if I spend $100, I can claim $150 by upliftment. All right. We won't get too much into this, but I'll come back to you on this in a little bit, and we'll talk in more detail when we get down to the individual, because I think our focus here today is on you as an individual. So taxes and employment. We need to be mindful, and it's all this thing about what I don't see, and it's very relevant. Let me go back and indicate to you. Taxes and employment, what you don't see, what you don't hear, and what you don't know could get you in trouble. All right, what you don't see, what you don't hear can get you in trouble. So what you need to appreciate is that once you understand what is required, you'll be in a very, very good place. So the PAYE system, it is a method of how you can deduct from employees' salaries and wages. So if you are employing people, you know, some of us like to take on people and say, well, you know, like for example, I have a kindergarten teacher as a client, and my advice to her is make sure that when you employ these people, make sure you take out the national insurance and PAYE for them before you pay them. Nobody getting $5,000, so they're not, nobody, you know, you're not in a place where you're paying taxes, but you have to pay health surcharge and therefore take the deduction and pay the national insurance. And the people come to you and say, well, you know, I don't want national insurance now, I don't really want that, you know, I want the money on my hand, give me all the money in my hand. And they do that, and you pray to that. And then the government says out, they give out a grant for salary assistance grant, and you're required to provide a national insurance information. Why? Because they're going to check to make sure that you're paying the national insurance. So if you have people employed, please make sure that you take out the national insurance when you can. All right. When a company has workers in a business, he or she assumes the responsibility of administering the PAYE system. Once you employ people, you have to administer your PAYE system. There's a question asked of us, are the taxes only payable when it is paid, i.e. if due to cash flow, you are not receiving salary? The payment of the taxes is due only when paid, not when earned. Well, let's make it very simple. As an employee, if an employer pays you, if he pays you an amount that is taxable, then he should deduct the tax before he makes the net payment to you. He has a responsibility to pay that with the Board of Inland Revenue. Now, COVID-19. I paid for my employees for the half month, and I said to them, based on that level, whatever taxes at that point, I as an employer will have to pay that over to the Board of Inland Revenue next month, May 15. The next 2 months in the month, I asked the employee to go and claim the salary relief grant. I pay no money to them after that point. I have no tax liability or tax exposure to the Board of Inland Revenue. Once you make the payment, or you make the you calculate the deduction, but couldn't make the payment because of cash flow, but that person is entitled for that payment in that month, then you are still liable. All right. So the fact is that I'm supposed to be paid this month, and you pay the national insurance and whatever have you, but the employer didn't have the money to do it because of COVID-19. You at least need to pay, when the time comes, you need to pay that over to the Board of Inland Revenue. I will suspect that as this whole thing is settled and people are unsettled by what is taking place, somewhere in the next near future, we'll find ourselves having some kind of tax amnesty to allow people to catch up and sort out themselves in some nicer way. If your workers are subcontractors, do you still have to pay them or deduct national insurance and health surcharge? That is a very good question. But let me qualify something. How do you know that your workers are subcontractors? Your subcontractor worker must have some evidence of being in business, and therefore they should provide you with a business registration certificate. What tends to happen, subcontractors I take on somebody and I tell them I'm a subcontractor because I don't want to pay taxes from them. But if you pay someone who is not a business, and you call them a subcontractor, and the Board of Inland Revenue comes to you or checks your books and records, then you will be held responsible as the employer for the payment of those taxes at 25%. The person that you call a subcontractor would have already got the money 100%, and that is okay. The taxman wouldn't go after them. He'll go after you as the employer. A subcontractor is only a subcontractor if you could give you evidence of the fact that they are a business. So they must provide you some business registration certificate, and you keep that on file and only give invoices, receive invoices from them and pay them against invoices. Somebody who is not a business registered and pay, and you just come and give you an invoice, you leave yourself with an exposure that you're likely to have to pay at some later date. If your workers are subcontractors, so please get evidence that they are subcontractors. The other question is, how do you treat with the situation where you hire someone just for a job to do work during a peak season? So it is not someone you will employ all the time. Okay. If I'm employing somebody for a peak season and employing them for 1 week, 2 weeks, 3 weeks, Christmas coming, and I'll take them on from November, or take them on from December, or take them on the week of Christmas, you should deduct for that week the national insurance payment for the week. If there's a tax exposure, you need to take into account. There might not be, because they will not cost the $50,000, $70,000 allowance. You have to first figure that out, because if you employ somebody, you should let them fill what is called a TD1 form to see if there are any tax exposures that you need to know about. And we'll come to that in a minute. So that this thing about only somebody for a short while. So I have a gardener, and the gardener employs 4 guys. So he came to me and said, I was doing the payroll for him and whatever. So we're doing the payroll and doing PAYE for him. But because everybody else is talking to him, why you do that as a gardener? Don't do that. You don't have to do that. You just take the money under the table. 2 things happen. If any one of those workers falls sick or ill, they can go to national insurance and claim on you. Some people understand and they know that you ain't doing it, so they might be okay. But the day they walk to national insurance, you could be caught out as an employee. I know of a case in point where the employer had a lady working for her, and don't take out the national insurance payment, gross, not a problem. A couple of months after, the lady got pregnant. She went to national insurance for the claim. National insurance came back to the employer, and the employer was liable to pay the national insurance outstanding. So you have to be very careful with that. Even those short 1 week, 2 week jobs need to be paid for national insurance. So if your worker is a subcontractor, please get evidence that he is a registered business. If not, get him registered or send him to be registered and let him pay you. If you're paying by, if I come as an individual and you take an invoice from me, then you still leave yourself exposed to taxes if the taxman will catch up with you. How do you treat with the situation? And this is the question, where you hire someone just for a job, right? Well, then you need to, the job is done. A job is either 1 week, 2 weeks, or 3 days, or whatever it is. Then for that, you have to deduct the relevant things for that period. If you have employees, you must be able to take out your deductions accordingly and pay to what the relevant statutory body. If you employ for a job for 1 day, like the work on an expo, and this is at $300 or $400 or $500. So I tell you what I do. I have a lady that comes to me to assist me with my house cleaning. She comes 3 days a month. I pay her national insurance for her, and I pay the health surcharge. Why? Because I don't want that to become an issue for me going down the road. Right? You may find yourself having to pay, because it's small money. It's $300, $400, $500, $900. Pay the national insurance for them, pay the health surcharge for them, so it doesn't become a problem for you. But ideally, you work 1 week. There's a national insurance calculation for 1 week. There's a health surcharge calculation for 1 week. That has to be paid to the Board of Inland Revenue, and that's what the law is. Each employer must register for PAYE if you employ people, and must do that with the Board of Inland Revenue. PAYE system. The PAYE system, every employee must furnish his or her employer with a BIR number. So if I come to work with you and somebody comes to work with you and they don't have a BIR number, it's a question you should ask. Do you have a BIR number? For those persons who you employ part-time and you bring them up, you should get some kind of data sheet and have information on them, their name, their address, their contact information, their next of kin, some contact number, some BR number, some national insurance number. So have a standard employee data form that you have that information. And that will make your life a lot easier in terms of record keeping and making sure the relevant payments are made and made on a timely basis. What tends to happen to most of us is that we don't pay attention to these deductions and these payments. And what happens is that down the road it comes to haunt us if you're not careful. And therefore, what you need to do, you have people that you employ part-time, full-time, on a job basis, get a standard form, and that form you have their name, address, and relevant information and BR numbers and whatever have you. So it makes your working up their calculations a lot easier for yourself. Every employee must give his employer a TD1 form at the beginning of a year or the beginning of time of work. That TD1 form tells the employer what your tax exposures are going to be. Every employer must record that the employee's BR number on each of the TD4 slips that he gives to the employee at the end of a financial year. The TD1 forms are stamped by the Board of Inland Revenue. The TD1 forms are the forms that you're given in advance so that people can make the calculations of your tax liabilities. You as an employer must give an employee at the end of a year a form called a TD4 slip, TD4 certificate, showing the employee how much money you paid him, how much taxes you took out, how much national insurance you paid, how much health charge you paid, and for how many months. Once you have a PAYE system in place and you're paying these people, every pay interval, every employer must break down the deductions and give against the gross salary and provide an employee with a pay slip. It's against the law not to do that. You have to provide the employee with the relevant information. Fail to comply with the above, you could be liable for conviction to a fine of $50,000 or 3 years imprisonment. I went quiet deliberately. Many of you don't realize that. If you fail as an employer to provide these documentation, you could get yourself in a little pickle. Yep. So you need to be able to do that. You need to be able to do that. A question was asked of me, what about non-paid interns? What about non-paid interns? If you're not paid, you have no tax exposure. If you have an intern that is not being paid cash for service, then there's no exposure. You're not paid, and therefore there's no liability and no exposure. On the other hand, or mentorship, how do you go about that process? Oh, well, if you're mentorship and you're paying, if you're not paying these people, right? You're not paying them for whatever service they're providing, whatever you're doing. You have no tax exposure, you have nothing to worry about. Don't even think about it. All right? The fines and imprisonment is for not keeping the PAYE files. The failure to comply with the above is you're liable on some conviction to this. Meaning, if you have an employee, the employee must give you a BR number, or you must get a BR number for the employee. I come to work for you, I didn't have a BR number, you give me a letter that's saying I'm employed with you, and that person goes to and let them fill out the form and send them to the BR to get their number, they come back and give you the number. When they come to work for you at the beginning of the year, could you fill out my TD1 form for me, please? So you have a TD1 form to show whether or not what tax liabilities you're taking out for these people and what you should and shouldn't do as far as your tax position is concerned. Every employer must record that an employee's BR number for each TD4 slip at the end of a year. So if you're paying an employee at the end of a 12-month period, December, by April following year, of March, February, in the following year, February, you're supposed to give them a TD4 slip showing all the deductions you made and all the payments you made to them. And that is also to be copied to the Board of Inland Revenue. There's a special standard form. I'll talk to you about that in a minute to show you. Every payment, at every pay interval, you must give an employee, be it weekly, fortnightly, monthly, give them a pay slip. Don't hand an employee, don't dash money to people and don't tell them what you do with the money. So if I'm giving you $400 or $500 or $1,000 and I'm taking money out of that to make statutory payments, you must give a pay slip and show people what you're doing. With regard to Stipends. I laugh because a stipend is what? A stipend is $400-500, and therefore you ought to account for the stipend, you know. A stipend doesn't absolve you from your exposure. So if I get a $500 stipend on a monthly basis or $500 stipend on a weekly basis, then I should sort out the issues that I may have in terms of their health surcharge and national insurance liability. I should sort that out. Just because I call it a stipend doesn't absolve me from the responsibilities that I have. There's ways of getting, there are ways of doing this, but I don't think there's only ways. Let me do it this way for you, and if you understand me, you'll see what I'm talking about. I said to you in the beginning, you ought to, you're not to avoid taxes. Avoiding it is not doing it. You need to evade taxes, and therefore you need to do things that allows you to evade the taxes. All right, you do the right things, or you do things in a particular way that you minimize your exposure to taxes, and there are ways in which you can do that. If you were working before, next question, and the company was deducting the health surcharge and national insurance, and it has no record of it being paid, what can you do? Woo! Question is, if you're working for somebody and they're not paying the statutory payments, what can you do? You can do quite a lot, actually. You can go to national insurance, ask the national insurance to give you a statement of payments to your account at the national insurance. It's a form that you fill out and they give you a sheet. If that employer is not on that list, and you report that to national insurance, the national insurance will go ask him about it. If he gives you a payslip and you have evidence that you're receiving payments from him, then they will use those things for them to prove that he has the liability to you. You go to the Board of Inland Revenue, it's slightly different because they don't have a set of compliance officers on the field, but they do. So you can go and complain to the Board of Inland Revenue also, and they will probably address it if they need to. But the issue here is, if you're working for somebody, they're supposed to give you as an employee a pay slip showing what was deducted from your gross income to arrive at your net pay. And whatever statutory deductions have been made should be paid over to the Board of Inland Revenue and the National Insurance Board appropriately. If it has not been done, then you can, and so within your rights, to go to National Insurance, fill out a form, ask the National Insurance, they'll tell you how much employers, you fill out the form and they'll show you what employer had, how many places were you employed, and you list all of that for them, and they'll go back into the systems and say to you, this is a statement of your contributions, and you notice that contributions are missing. Then you could report to the National Insurance Board and you could give them copies of your pay slips, and then they will take it from there and decide what they have to do. Now, it's very important that you every now and again, every 4 or 5 years, let's say, you go and confirm with National Insurance what contributions you made, because from a National Insurance point of view, your benefits accrue tremendously as and when you qualify over the 750 contributions. And that is why it's important to ensure that when you're working for somebody, that you're seeing those contributions being made, and every year or so you check up on it. Where do you get the next question would be, where do you get the TD4s to provide the employee, and can you download it somewhere? Well, the way things going, they're putting everything on download. I will show you what a TD4 slip is in a little while, and I'll tell you and discuss with you then how you will progress and deal with it. The other question is, you mentioned earlier that the only way directors can take funds out of a business was by taking a salary. What about taking drawings? Drawings only relate to sole traders and partnerships. Drawings, if you are a director is a director of a company. You're not a director of a sole trader. You're not a director of a partnership. You are a sole trader. You are a sole trader. You're a partnership. You're a member of a partnership. And therefore, in that context, the income or the money that you take out of the you don't have a salary coming out of the partnership. You don't have a salary coming out of the sole trader. But any money you draw out of the partnership is taken out as drawings, or the sole trader is taken out as drawings. If I'm working for a company, You cannot take out drawings. There's no drawings in a company, none. Because if you take out money in a company, it becomes and it's not a salary, it becomes a director's loan. And that is taxable to you in time, meaning that if the Board of Internal Revenue sees that you have a tax liability from a director over a long period of time, you could find yourselves in a place where you're paying taxes on that liability. So be careful there. So directors don't have drawings. Directors get salaries or they get directors' fees out of a company. Sole traders and partnerships take out drawings. So the PAYE system. So every employee must furnish with the BIR. Every employee must give his employer a TD4 slip. You must have a TD4 form, etc., etc. What's up? My machine appears to be hanging up. What is going on here? This happened at the same time last time. I will just a minute again. Let's go back. Oh wow. Look. Right. Let's see. So in that PAYE system, therefore, the employer is required to retain records of emoluments paid and taxes deducted from each employee. As an employer under the PAYE system, it is your responsibility to maintain the records of emoluments paid and taxes deducted from every employee. The total tax deducted must be remitted to the Inland Revenue Division on or before the 15th of the following month in which the tax was deducted, together with the monthly return. There's a monthly return form that you must file. Remember, I said to you, the way the tax works, I can go and pay taxes into the Board of Inland Revenue, but that says nothing unless I put a return in that match the payment being made. So the return, the tax return must be put in, I must make the payment. A business levy, greenfield levy payment must be made along with a return for these things before you get the payment, before the payment is made. So each time you make a payment to the Board of Inland Revenue, you must also be filing the necessary return. Without the return, the money goes into your account, yes, and it might not be properly allocated. You got to present the return to ensure that there's proper allocation of your payment. So let's deal with health surcharge. This has been on our mind for a little bit, and we've been talking about it, so let's deal with it. A health surcharge is payable every employed person who is also liable for national insurance contribution ought to be paying health surcharge. Individuals who are required to pay health surcharge must furnish an income tax return, meaning if you're employed and you are getting emolument income, paying national insurance, you should be paying health surcharge. You're exempt from paying health surcharge if you are 16 years of age. Under that, persons who have attained the age of 60, or persons whose only source of income is pension. A person's only source of income is pension can not pay health surcharge. Health surcharge is a very simple quantum of money, so I don't want to be caught out for not paying it. Monthly income payment for health surcharge is, weekly payment is $480 at a certain level of income, $469 per month. Income in excess of $469.99 per month, you're paying $825. The majority of people pay under the $825 category. All right, so that you are able to come to a place. This is a very simple payment. It's $107.25 on a quarterly basis for you self-employed people. Paid on a quarterly basis in March, June, September, December, or write a check for $429 or pay the cash, pay it in advance one time so that you don't have to worry about going back and forth and paying that. But the other taxes, from a cash flow point of view, is something that you don't want to necessarily do. So health surcharge payments for the self-employed person, health surcharge is payable quarterly, and you all are self-employed persons. So for you, your health surcharge, you ought to be paying it on a quarterly basis, $107.25, because you're assuming that you're making more than the $469.99 and therefore you pay it at 107.25 for the quarter period. For persons who earn emolument income, health surcharge shall be deducted by the employer and remitted to the Inland Revenue on the 15th of the following month. So as part of your salary deductions, if you employ people, you ought to be deducting the health surcharge payment from their income and paying it across to the Board of Inland Revenue come the 15th of the following month. Here's the beauty part. Failure to deduct and remit, failure to deduct and send the health surcharge is an offense. It's a penalty of 25% of the amount plus interest of 20% per annum is payable on such circumstances. So in addition to paying a penalty, you're going to pay interest. You're paying 25% penalties, penalty meaning where we have to pay 25% of that is a penalty. And now we're paying now interest on the outstanding payment. Boy, it gets more and more difficult. I will also give the advice that says, if you are not paying taxes or you fail to pay taxes in a timely manner, the first thing you need to do is to get the principal paid to stop the interest running, and then deal with the interest afterwards. But don't pay interest, don't pay part interest and part penalty, part interest and part penalty. No. You're going to the Board of Inland Revenue and indicate that this is the principal sum being paid, pay the principal sum, and so that once the principal is paid, no more interest will be accruing, and therefore you will pay the interest afterwards. And that's a nice way of doing it to avoid any additional liability. Get the principal paid first, we'll deal with the interest after. Worse yet, in this current time of COVID-19, and your cash flow is affected, and you're not being able to pay your statutory payments and stuff like that, then when night follows day, we expect that we will have a amnesty at some point. When that amnesty comes, make sure you have the money and pay up all your principals, because the interest will probably be written off at some point in time. Okay. Thank you very much for that. So those little snippets you get, you see, you have the information, but unless you appreciate and understand how to play the game out there, you'll find yourself challenging. It's important that you do a course such as this one, so that you get a different sense of what it is. You have the information now, and as I said at the beginning of the program, if you have the information, you're king in the game. You know exactly how to handle your business. The employee has to give you something called a TD1 form. The fund of the TD1 form is just basic business data, name, address, and stuff like that. But the TD1 form, and this is the back of the TD1 form, this is the top half of the TD1 form. There's a personal allowance, and there's an old form, it's $72,000 now, it's not $60 anymore. There's tertiary education grants and those things. So this form must be filled out, the new one, and given to the Board of Inland Revenue and the employer. The employee gives it to you. He gets a stamp for the Board of Inland Revenue if he has allowable deductions that he has to account for. If he doesn't have any significant allowable deductions like annuities and stuff like that, then he can give you the form straight away, and that's it. Now let's deal with the form that somebody asked us a while ago. This is the 2012 form, but all the forms are the same and they look the same all now. The form will have this current year and the year in question to the right-hand side. This is a TD4 certificate. This is a TD4 certificate. And you should, as an employer of people, you need to go to the Board of Inland Revenue, and these forms are pre-printed for the relevant year in question, and they will give you these forms. You have to do a letter indicating that your business name under your letterhead and whatever have you, and indicate the number of employees you've had for the year, and they will give you sufficient forms for you to do this. These forms must be filled in quadruplicate. These forms need to be filled out in quadruplicate. One for your file, one for the Board of Inland Revenue, and two for the employee. The employee keeps one, and the employee sends the one to the Board of Inland Revenue. Now you see how it works. You as the employee sends one to the Board of Inland Revenue, and the employee sends a copy of that to the Board of Inland Revenue, and they get in the Board of Inland Revenue, and they come together and they tie them back to make sure that what you say is what has happened by the employee. So these forms are filled out in quadruplicate. You can go get them at the Board of Inland Revenue. If you have a payroll system, then the Board of, depending on what that payroll system is, the payroll system can self-generate these forms on approval by the Board of Inland Revenue. So the software developer of your payroll package, if you employ people and you want a payroll system, MicroPay, TTPay, whatever those accounting, those payroll systems might be, these applications have approval from the Board of Inland Revenue to print these relevant forms in the year in question. And as you see here, the forms indicate the gross income, the deductions being made, national insurance paid, the income tax deducted, and at the bottom there you see the health surcharge for the number of weeks paid. You enter the traveling allowances, you enter the company stamp on the top right-hand corner, and you must initial it for the employee. Stamp it and initial it there. And then, of course, you have all the taxable deductions and all the payments otherwise being made. It's a very important thing to do. The next question here before me, the problem that I have is when you go to the BIR office, the staff either don't know these details or they don't care. I don't have an answer for you for that, I really can't help you there. But I will say this to you, you need to inform yourself. And therefore, if you go onto the website of the BIR, you can download not only forms, but you can download booklets that explain these things that I'm talking about. You can go to the website of the BIR, go to the section on forms and booklets, and you could download booklets that explain all these things that I'm going to share with you today. Yeah. I will tell you this much too, as you made that comment. In light of COVID-19 today in Trinidad, you watch and see how customer service in certain government agencies will begin to change. That will also happen. So you may find that going down the road, they may be a bit more friendly because it is a measure that the government has in relation to performance of state agencies and ministries. So we'll see what happens there. So that's your TD4 form. That's your TD4 form. And now we will deal with this job, sole traders and partnerships and wages and salaries. But you know something, I shouldn't start this now. I should let you take a break. We're going to go early today, and we'll try and finish a bit early today too. So could I say to you then, it is now by my watch, 11:43. Let's assume that to be 11:45. It's 15 minutes before 12. I don't necessarily want to go for 45 minutes now. I would like us to just take, could we just break for 1/2 an hour? So at 12:15, I want to come back and we will move quickly to get you out of the presentation, let's say by 1:30 for the latest. In terms of getting your time, there's information that's going to be presented in terms of I'm going to go back into I'm going to shift from the PowerPoint presentation and get into the forms. Part of the problem that some people have in the forms of the Board of Inland Revenue and these people is that, if you go to the forms might be simple or the form might be complex. In all cases, these forms are very simple. You just have to know what you're going to have to get and how you're going to have to fill them out. I trust that the question here is your pay, if you pay your workers a bonus, would that be taxable? And the answer is yes. Bonuses form part of what we call emoluments. Emoluments are your salaries, your bonuses, your overtime, your acting allowances, your vacation, all those things form what we call emoluments, and emoluments are taxable. Please bear that in mind. There's very little that you get in cash in hand that is really not taxable. Very little. All right. So I like the fact that your questions are coming through the chat. I trust I've answered them satisfactorily to your benefit. As we go forward again, you can put more questions in the chat. I am present here, so you can still send some questions to me, and we'll get them answered to you as we go along. So I want to thank you very much for paying attention and listening, and I trust that you are being enlightened and you're learning as you go along. And when we come back at 12:15, we will do some more and you'll be educated. So it's now 11:45. I see you again at 12:15, and I thank you so much for your attention. See you soon.